Well, Unifor has reached a tentative agreement with GM Canada, ending a brief strike. For more on this and what it means for over 4,000 workers now heading back to work, we're joined by Stephen Tufts. He's an associate professor of labor geography at York University. Stephen, thanks so much for joining us today.
Thank you for having me.
So it was a brief strike, but it seems powerful in the sense that they were able to get to an agreement quite quickly. Do you think that should be a takeaway from this?
Yeah, I think I don't think a strike was entirely unexpected. Maybe we expected one to be a little bit longer. There's a couple of reasons. First of all, this was a strong pattern set by Unifor with Ford. It's a very good agreement with a significant gains. It's a costly agreement for GM because its workforce is a little bit older and there were pension enhancements. But the second point, which I think needs to be considered, is that this agreement was only ratified by 54% of Ford workers. So a lot of workers weren't really enamored with it. And by not going right to the pattern right away, GM maybe signaled to workers that you're going to have to strike to get us to the pattern, and there's no way we're going to go above and beyond it. So we'll see now if GM workers, after a short strike, will ratify the agreement.
Yes, this pattern bargaining, so the idea that they would do one deal with one automaker, then take the exact same deal to the next one and to the next one. It's interesting that you bring up, because of the demographics of the workforce for GM, that changes the equation a little bit, or could have.
Yeah, it could. I mean, again, we have to put this in perspective. These are all very profitable companies right now. And GM was also vulnerable and did not want a long strike in any means because its truck factories are going at full capacity, and it would leave a lot of money on the ground if some of those assembly factories were shut down for any lengthy period of time.
Are there risks, if you're coming at it from the union's perspective, with these pattern bargaining, this sort of setup, that if you don't get the exact same deal with one of, in this case, three, that you lose some momentum? So getting to Stellantis after that, you might not be able to get what you got with Ford out of the gate?
Absolutely, and that's the issue, and it works both ways. Unifor was determined to have this pattern signed on by GM, and they're going to be determined to take the pattern and get Stellantis to agree to it as well. However, there's a little bit of a wild card at play here. David Cassidy, who's the president of Local 444 in Windsor, has signaled that he's not really happy with the pattern agreement negotiated by the national level of Unifor at Ford, and that maybe Stellantis, being a very rich company, will be asking for more and break the pattern agreement the other way, which is very tricky for the union and gets us into some interesting waters.
So, okay, interesting. I wonder, too, from the workers' perspective, well, also from the automakers. So if you don't agree to the pattern of one of the other, that one of the other companies does, that could put you at a place of risk if some of the employees know, well, the automaker over there is going to pay me a lot more, so why don't I go work for that company instead of sticking with my company? Are there risks there as well?
Yeah, I think the greater risk is just violating a sense of fairness to workers. It's very difficult for workers with 20 years seniority to simply cross the road and work for another plant. It doesn't really work that way. But it really would make workers unhappy if you have the capacity to pay a similar wage and refuse to do so. Again, the whole idea of pattern bargaining is to take wages out of competition, so that the big three can compete on technology, on who can produce the better EV or electric vehicle, who has the better quality vehicle, but they don't have to compete on the price of labor. And that's the whole point of what Unifor is trying to establish across Canada and in some cases in other jurisdictions as well. What
do you think other unionized workers would take away from the success that Unifor is having with these automakers?
Well, I think, this is a time of heightened labor militancy. We're coming out of a pandemic. where wages were not dynamic. A lot of people were even laid off for significant periods. We're also in a period now of high housing costs and high inflation, and workers realize that in order to struggle, the struggle is necessary to keep up. And I think what you're seeing is that with some bargaining, you can achieve significant gains. Ford and the GM agreement was achieved without a strike. The GM agreement was achieved with a 6-hour strike. We'll see if the workers ratify it. So with struggle, with this happening both north and south of the border in North America, we're seeing some significant gains at the bargaining table.
All right, Stephen, great to get your perspective on what's happening, some context out there. We really appreciate it.
Thank you very much.
That was Stephen Tufts, Associate Professor of Labor Geography at York University.
Now, the war has raised concerns around broader tensions in the Middle East, and today the CEO of Pioneer Resources, which was just acquired today by ExxonMobil, told Bloomberg News oil prices could surge if the Israel-Gaza war escalates to include Iran.
Will be between 80 and 100, and that's where we've been. So the big question is, does Iran and Israel, does Iran get involved in the war? It's proven that already that they knew about it. They said yes to Hamas invading Israel. So the question is, Netanyahu's got to make a tough decision. If Iran gets involved, it's going to get bigger and bigger, and it'll significantly affect oil prices.
Well, let's get some reaction to all of that. Clay Siegel joining us, a global oil service director at Rapidan Energy Group, who's been tracking all of these developments. Clay, thanks very much for your time. I guess from the oil perspective, what are you watching most closely right now?
John, thank you for inviting me. Before we talk about market implications, this is first and foremost a human tragedy of epic proportions that has unfolded in the Middle East, and that's where our first thoughts in the matter are. When it comes to the energy market reaction, we believe that Mr. Sheffield has it just right. The main thing to watch for is whether Iran becomes actively involved in the shooting in the conflict. And the reason why is because of Iran's proximity to that really crucial waterway called the Strait of Hormuz, through which some 15 plus million barrels a day, maybe 41% of the world's total exports flow each day. If Iran gets involved in an active war situation, whether or not it involves the United States, then it's entirely possible that we could see disruptions to that crucial oil and gas waterway. So far, oil markets are not yet really pricing in the risk of that big disruption. It seems that traders and analysts are focused on the idea that it could be contained to the Gaza area, but that's the number one thing to watch for, is potential involvement by Iran.
One of the things we've talked about within the energy sector very closely in recent months is for OPEC or OPEC plus nations, their ability to control supply. For those who would look at this situation and point to the possibility of spare production capacity from OPEC nations, how would this situation play into that? What should our audience know?
That's a great question. You know, the oil market basically has two cushions to guard against supply disruptions. One of them is the level of oil inventories, which is barrels of oil that have already been produced out of the ground and are in storage tanks somewhere. And the other one is spare production capacity, which is held by really just a couple, 3 countries within OPEC right now. And neither of those two cushions are particularly reassuring if we think about the risk, and this is not our base case, but the risk of Iran getting involved and causing a major supply disruption from that part of the world. The amount of oil inventories that are held commercially in the United States and in other countries is down significantly in the third quarter compared to the first half of this year. And the strategic petroleum reserve that's held by the United States government is only about 350 million barrels compared to 600 million barrels plus before the Russian invasion of Ukraine. And then on the spare production capacity side, that's really important. The good news on spare capacity is it's higher than it was in recent months. It's about 5 million barrels per day. But the major catch with using that spare capacity, it is almost all upstream of that Strait of Hormuz, the crucial waterway. So if that's where the disruption takes place, it doesn't matter how much spare capacity could be activated in the fields. if it can't get to market.
That's helpful context as we watch this all unfold. We were just speaking with Ethan Bronner, who is based in Tel Aviv, covering this for Bloomberg News, and he was discussing some of the action the U.S. has been taking to make its presence felt, if you will, in the region. As you're watching to try to determine where this goes, what level of escalation within the broader area, and whether Iran enters the picture in a more notable way, I would assume then you're going to be watching the commentary coming out of the U.S. throughout the next few days as well?
Well, we are, certainly, and it sounds like the U.S. is giving its steadfast support to Israel in the conflict and has already started a resupply of munitions, other war material, and as your correspondent said, deploying forces to the region. The other thing to really keep an eye on with regard to the extent to which Iran could get involved or the conflict could spread to another front is the border between Lebanon and Israel. This is where the Iran proxy, Hezbollah, Party of God, is concentrated and is strongest. And there have already been some border clashes, some skirmishes between the sides. We're watching that border area very carefully to see if that could signal an expansion to the northern front for Israel.
And before I let you go, just briefly, I know this is such a difficult situation for everyone, and it's even more difficult to try to determine where we go from here. I noticed some headlines from the president of your firm, Bob McNally, this week about the possibility, almost a 20% chance, I suppose, of that Iran factor at this point. Can you give us a sense on how you'll determine what the odds of that escalation are and whether that leads to some potential oil crisis?
Well, again, the number one thing that we're looking for to see if that 20% might go higher is whether Hezbollah and Israel get into a major shooting war in that northern border area and even beyond in other parts of Israel and Lebanon. That would probably be a signal that Iran has either already become actively involved or is about to get involved.
The Weeder family of Hudson Hope in northeastern BC have a herd of around 1,400 bison. Now, they just opened an on-farm processing plant. They can slaughter the animals there and also prepare a wide range of meat cuts. We're joined by Christopher Weeder. He's owner of Venator Ranches, also known as the Bison Guy. Great to see you, Christoph. Tell us, I gather Canada has in 2021 had just over 140,000 bison in various farms, but tell us, what's the advantage?
Well, I mean, the reason we built the slaughter facility is the fact of the distances. We live in northern British Columbia. The closest slaughter and harvesting facilities to us are over 10 hours away. And with fuel costs increasing and transport costs increasing, it just digs into our bottom line so much, by having to transport those animals. On top of that, when we sell the animal to a packing plant, it's sold to a distributor, and then the distributor sells it to a wholesaler, and the wholesaler sells it to a retailer or a restaurant. And everybody's taking a chunk of the pie away, and the farmer's left over with the crumbs at the end of it, and no control over his markets and where we sell and what we do in our returns. And we felt that to really have a long-term sustainable return on our animals and predictability, we need to be in the food business and own the animal right to the end point.
Less stressful for the animal as well, not being driven long distances to the abattoir.
100%. It's an animal welfare issue. I mean, bison, as much as we do ranch, we have them in farms and we ranch, they are still a wild animal. They obviously get used to us out there, but as soon as you start putting pressure on the animals or loading the animals, stress goes up. It affects meat quality. It's an animal welfare issue. It's a number of things. So what's beautiful about our facility is our animals are literally walked off the pastures the day before it's their day into our corral system that holds them before they go into the packing plant. And the animal never goes through any of that stress. And at the same time, we never have any issues with having to figure out how to truck them somewhere.
Who's the big buyer of bison meat? Is it the retail consumer or is it the restaurant trade?
Well, prior to COVID here, a lot of it was going into the food service industry, and there is some retailers in Canada carrying it. But it's the bison industry in Canada has had probably 3 booms and busts in the last 25 years related to border issues. The vast majority of the bison in Canada, be it the live animal or be it the meat, is going into the United States. Then second market to that would be going to Europe. Switzerland and France would be the #1 markets for that. So, I mean, a lot of it is restaurant trade, and we took a different approach that we felt we wanted to be connected to the consumer. And so we are a direct to consumer, and 99.5% of our customer base is the person that is actually cooking a meal for their family or a barbecue for their friends on the weekend. We have skipped right past the retailers and the food service industry.
We're very tight for time, but say somebody in Toronto wanted to buy your meat, would you ship it to them frozen, or how does that work?
Unfortunately, our laws in Canada with inspection prohibit me from selling it outside the province of British Columbia. I would have to be federally inspected in order for that meat to go to Ontario. And even though I'm 2 hours away from the Alberta border, I am not legally allowed to sell my meat into Alberta, although someone can come across the border and pick up the meat here.
Christophe, a really interesting story, and thank you very much for joining us.
Obviously, the markets are watching very closely. There are concerns about greater tension across the Middle East right now. We're looking at the U.S. futures higher today, but in many ways, this story is about investors also buying bonds and the fact that that pushes down bond yields, and then investors ultimately end up acquiring equities. We mentioned already oil prices have been surging, and some of that is certainly tied back to the Middle East uncertainty. Jeffrey Kleintop is Chief Global Investment Strategist at Charles Schwab. He joins us now, and it's great to see you, Jeffrey. And I know that you've been fielding a lot of questions from your clients about how one is supposed to look at such a story of uncertainty and make sense of it right now. What's been your perspective?
On the geopolitical risk, it's really an ever-present part of investing, and there are times when it flares up, and we all feel the impact, and the human toll is not measurable and unimaginable. But the market impact of these types of events, and unfortunately, we have a long history to look back. We have 50 some odd years of attacks in and around Israel. 23 of them, the market's reaction has tended to be fairly muted initially, and then usually within 5 days having fully recovered. And one of the reasons for that is that we rarely see oil flows being disrupted. If you think back to the invasion of Ukraine by Russia, that did have the risk of displacing global oil flows from Russia. Russia supplied 10% of the world's oil. And so you saw a much bigger spike in energy prices and a bigger impact on the markets. This is now just a risk to global energy supply tied to Iran and other areas in the region. And so far, those risks are unfounded. Oil continues to flow, and Saudi Arabia has a spare capacity to bring it online if they need to. And that is one of the reasons why the market's reaction has been fairly minor.
And I guess, as a number of energy watchers have said, looking to countries like Iran and their continued comments on this subject is going to be worth watching, because obviously further escalation raises more questions about the supply story. But that's helpful context. Maybe you can give our audience some context on the broader market story. We're sitting here, we're now into almost the middle of October. It's been a choppy few weeks for the equity world, and I think a lot of people who want to stay committed to stocks are trying to figure out where to be positioned. Tech had that big run up here in Canada. We've talked about how the Canadian market overall has struggled this year. What are you watching within equities right now?
Today's news from the big banks in the U.S. is probably as important as any economic data point as we look at the broader economy. What was really interesting is that while there was some sign of increasing credit card losses and related losses given the rise in interest rates, overall, JP Morgan, for example, reduced the pile of money they had set aside for potentially bad loans by $113 million. Analysts had expected a reserve build. Wells Fargo said the same thing. They reported a $1.2 billion new provisioning for loan losses, but that was less than analysts expected. So it seems that while the rise in interest rates is leading to further delinquencies, charge-offs, bankruptcies, we know this, banks seem to be adequately reserved, more than adequately reserved perhaps, for these losses. And that's relatively good news. And one of the things that's maybe offsetting the negative geopolitical tone and the rise in oil this morning is that it looks like consumers are maybe faring a little bit better than many analysts expected in the face of these higher rates.
So I hear you talking about banks. We don't have earnings. We're on a different cycle for the Canadian banks, but they do make up a pretty big chunk of the Canadian stock market, along with oil related stocks. How do you feel about the TSX? You know, if you were looking for an investment in Canadian stocks versus U.S. stocks, how would you feel about that kind of positioning going forward?
Overweight Canadian stocks versus U.S. stocks. Not only you mentioned the financials and the energy exposure, which I think are two sectors that we're most attracted to right now. And so that alone is a positive. But Canada is a secret outperformer right now. Canada has been one of the best performing global stock markets this year. The average Canadian stock is outperforming the average U.S. stock this year, something investors who only focus on the capitalization weighted averages might be missing out on. In fact, the equal weighted MSCI Canada index is up about 5% so far this year. That's nothing to write home about, but the equal weighted S&P 500 is flat this year. And that just shows how concentrated the gains in the S&P 500 been around those 7 mega cap stocks tied to AI. If you take those out or you look at the average stock, it's really pretty flat. We're seeing much better performance out of the Canadian market. I think it's likely to continue over the remainder of the year.
Okay, actually, it's a helpful point there, yeah, because we get so caught up in the overall market cap leaders and the overall index performance. Jeffrey, thanks very much. Good to see you. Jeffrey Kleintop joining us from Charles Schwab with his take on the markets.